And of course, and the way I've been describing it recently with some of these recent military events is that sovereign debt crises basically are likely to lead to war in a similar way that war is likely to lead to sovereign debt crisis. They tend to feed on each other because obviously one of the ways that a country can get in debt is war. But on the other hand, if a country already finds itself in debt and is running into its own kind of inflation problems or financial stability problems, then other countries can perceive that as weakness and say, well, let's see how well they can do war when they're already this indebted. And so then they strike, or they get something that they've been wanting for a while, or they feel is theirs, or X, Y, Z. And so we are seeing, I think, an uptick in just more hostile actions globally.
In this snippet from Lyn Alden's Insights, she delves into the potential ramifications of a financial collapse, drawing parallels to historical events. Highlighting the interconnectedness of sovereign debt crises and warfare, Alden warns of a concerning uptick in hostile global actions, likening the current decade to the tumultuous 1940s. With increasing signs of kinetic warfare, she emphasizes the critical role of leadership and public sentiment in steering the world away from potential devastation.
It's hard because no one, I don't think anyone knows for sure, right? I think that every situation has new aspects to it. Um, Basically, it would look like, I think Luke Groman has used this term, basically like the U.S. with Argentina characteristics, more or less. Like it's kind of like some hybrid between a developed country and a developing country, and when they go through a currency problem, in the sense that you could get a period of just uncontrolled inflation and polarization in politics because of that. And one of the reasons it's dangerous is that you can get, part like the last monetary reset that happened. Um, uh, Brought, for example, extremism out of Europe. And in the United States, we had big changes too. They weren't as extreme, but they were big changes of centralization and things like that. When Russia went through theirs, obviously that was a very strong tilt to the other direction that was devastating for the people. And so that's the risk in this situation. Potentially, some of the areas that can benefit are emerging markets that have dollar-denominated debt, because if something does happen to the dollar, their debts get devalued, right? So right now they've been in an environment where, as the dollar hardens relative to their currencies, that can make it harder for them to pay back their debts. But if you go through a big dollar weakening cycle, either a normal one like we saw in the 2000s, or a bigger one due to an actual kind of structural problem, that's tends to be when you get booms in emerging markets, because it's kind of like, after years of tightness on them, they finally have a kind of a release valve. Um, but I don't think the U.S. is going to lose its currency situation without a fight. Basically, I think they're gonna hold on to it as strongly as they can, even to their own detriment, the way it's currently structured. And so I think that probably what it looks like is a really weird period of capital controls, stagflation, uh, increasing political polarization, and then it really comes down to where public opinion goes, because eventually people can't put up with it anymore, and they start coalescing in a different direction, and that different direction could be a better direction, or in some cases it's a worse direction. Unfortunately, it could be fascism or communism. Basically, those are like the wrong paths, and the right path is something else, something more stable. And so I think that's the big challenge. And of course, and the way I've been describing it recently with some of these recent military events is that sovereign debt crises basically are likely to lead to war in a similar way that war is likely to lead to sovereign debt crisis. They tend to feed on each other because obviously one of the ways that a country can get in debt is war. But on the other hand, if a country already finds itself in debt and is running into its own kind of inflation problems or financial stability problems, then other countries can perceive that as weakness and say, well, let's see how well they can do war when they're already this indebted. And so then they strike, or they get something that they've been wanting for a while, or they feel is theirs, or X, Y, Z. And so we are seeing, I think, an uptick in just more hostile actions globally. I've been comparing the 2020s to the 1940s for years now, and I've been always saying like I'm comparing it in the macro context, like fiscal and monetary cycles to that period, and I would always say I hope it's less kinetic than that other period. We're unfortunately starting to see early signs of increasing kinetic war, and so that's a big variable. I mean, I don't know what the world's going to look like in 5 years. Maybe it stays at a simmer, or maybe something more devastating happens. And it kind of just comes down to what the leaders are going to do, what people are, are people going to get tribalistic and elect kind of crazy leaders, or are they going to kind of keep their head on straight and try to de-escalate? I think there's multiple things that are happening kind of simultaneously, and it's hard to judge where that goes, admittedly.
Lyn Alden continues to dissect the cyclical nature of financial systems, stressing the inherent instability of fiat currencies. From recession to recession, central banks employ tactics to sustain credit growth, perpetuating a cycle of mounting debt. However, when interest rates hit rock bottom and debts reach unsustainable levels, a financial crisis looms. Alden elucidates how this crisis often culminates in a transfer of private debt to the public sector, leading to currency devaluation and potential monetary system resets. She speculates on the uncertain future of money post-reset, citing Bitcoin as a potential contender. Despite the unsettling nature of these discussions, Alden reminds us that such transitions are not unprecedented, pointing to historical examples and emphasizing the importance of preparedness in navigating turbulent financial landscapes.
I think the reason it's important to keep track of it is because that cycle is associated with monetary change in a big way. And what I described before is that fiat currencies, the big ones at least, are metastable, meaning that they have some degree of stability during their lifetimes, but they are not fully stable. And so small amounts of problems build up and get papered over from recession to recession to recession. But the problem is they don't go back to their prior baseline each time. That'd be a stable system. Instead, it's always a little bit more kind of duct taped and papered over until these things really build. And so one way to visualize it is so for 40 years in the United States, whenever we had a recession, central banks would lower their interest rates, and that would encourage more credit growth to build up, as everything's reliant on credit just always going up. One stat that I gave in the book is that from like the 1960s, which that particular data set, all up to the present day, the total debt in the U.S., so public and private debt combined, increased every single year smoothly and without fail, with one brief exception for 18 months during the global financial crisis. It went down by like 1.5%, and then they basically pulled out all the stops to keep that going up again. And so what happens is that without constant credit growth, the system as it's currently designed starts to fail. So they lower interest rates and they encourage and allow for higher levels of debt loads without having higher levels of interest expense. And that's a cycle that kind of just recession after recession after recession keeps happening until they run out of room. They basically hit zero interest rates or even mildly negative interest rates, and debts are extraordinarily high. And then they run into basically a financial crisis that happened in 1929 and it happened in 2008. That's basically when zero is not enough, when zero interest rates are not enough to kind of keep the system going. And so then there's expansion of the monetary base. There's a transfer of private debt to the public realm, basically money printing. But then that last part of the cycle is that if money, it's kind of like the problem keeps getting kicked upstairs, right? So it's like, you start in the private sector, it goes into the banking, the real estate sector goes in the banking sector, and eventually a lot of that excess gets just put into the sovereign level. And then the problem there is that once a sovereign is highly indebted and interest rates are no longer going structurally down because they basically bounced off zero, and if they're ever having any sort of inflation challenge, and if they raise rates, those interest rates are a much less effective tool for controlling inflation because they blow out the fiscal deficit. If you have like 150% debt to GDP and you raise rates to 5%, you're going to vastly increase your fiscal deficit. And then if you're like Japan, the central bank is stuck monetizing it even during periods of above target inflation. And so generally, when systems get to that point, they start getting on track for a reset, or perhaps the less loaded word is recapitalization, where they end up, if it was an emerging market, they would default and restructure on their debt because they would have debts that they can't print, like dollars. But in countries where the liabilities are printable, they basically devalue the currency significantly, and that's been a cycle that's repeated several times. And then with it, usually it's a switch over to another type of money, right? So you go from a gold-backed system, for example, to the Bretton Woods system, and then you go from the Bretton Woods system to just a fiat currency system. And the question is, and this is why it's relevant today, is what's on the other side of this system, right? So as the major powers, and it's not going to happen in 6 weeks, but I mean over the years or decades ahead, as these big countries work through their untenable debt loads, and they no longer have that declining interest rate to offset them, as they either sharply devalue their monies, damage their own monetary network effects, especially in a world where new things exist now. What's money going to look like on the other side of this event horizon? And we don't know yet. I would say, I would argue that Bitcoin right now is a strong contender. I also think depending on when that happens, there can be a period of central banks recapitalizing themselves with their gold. So a kind of a sharp currency devaluation that then gets kind of tethered to gold for a period of time to regain kind of stability and confidence in it. But these are kind of uncomfortable situations. I mean, these are something that if you talk about them, you sound like a doomsday person. But really, I mean, these things have happened in like our parents' lifetimes, and in emerging markets, they happen all the time. And if you describe a period of high inflation due to a sovereign debt problem, and people say, no, that's doom talk. And I say, no, that's literally, I, for example, spent the summer in Egypt, and they were having 37% inflation when I was there. And it was terrible, but it wasn't doom. It's like life finds a way. It's not saying that it's the end. It's just saying that there's a transition period, and there's chaos, and there's risk, and there's people get hurt by it, people get helped by it, depending on how well positioned you are for it. And it's just a messy situation that sovereigns go through once they start getting very indebted.
As we conclude today's enlightening discussion, let's recap the key insights from the transcript. We've delved into the complexities of global monetary systems and the potential challenges ahead, including currency crises, inflation, and geopolitical tensions. Our guest has provided valuable perspectives on the cyclical nature of financial systems, the risks associated with excessive debt, and the possibilities for monetary change on the horizon. Thank you for joining us for this thought-provoking conversation. If you found this discussion informative, be sure to subscribe to our channel for more insightful content. Don't forget to like this video and share your thoughts in the comments section below.